Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about Palantir Technologies PLTR stock and why many investors believe this company is actually only worth $5. Then we're going to move on and talk about Tesla's TSLA stock and why it is selling off right now, and we will also be determining whether or not Tesla is still a good buying opportunity for the rest of 2022 as well as 2023. After that, we're going to go into detail about Nio Stock to determine if this company is a good buying opportunity, a selling opportunity, or if we should hold it throughout 2023, because spoiler alert, there's a huge catalyst coming up for Nio, which I think is going to be fantastic for their overall stock price. But this company will come with some necessary risk, which we will get into later in the video. And then lastly, to wrap everything up, we're going to talk about Mullen stock, ticker symbol MULN, and why this particular company has recently hired a former General Motors employee named Ronald Dixon to help lead their overall federal government sales. So we will be getting into that. So for more videos like this one, don't forget to go and smash that like button right now, comment your thoughts down below, subscribe if you are new, and without further ado, let's jump into these news updates for these companies, starting off with Palantir Technologies. Palantir Technologies is a big data and analytics company which serves both commercial enterprises as well as government clients. Palantir Technologies right now and their PLTR share price is currently trading at $7.20 per share, while professionals believe the company is worth $5 on the low end and $15 on the high end. Now, many professionals as well as investors believe this company is going to lose value over the next year, dropping down to or even potentially below $5. However, the good news is that recently this company announced a strategic partnership with Crisis 24, and they are a leading integrated risk management firm that essentially specializes in security as well as risk management. So Palantir is going to help this company through their AI capabilities to become even more efficient. Apparently, this long-term strategic partnership is worth millions of dollars. However, we haven't been given an exact price for this particular partnership. But apart from that, Crisis 24 has unparalleled expertise in both knowledge as well as implementation in regards to crisis management as well as overall intelligence. That's why they're actually going to use Palantir's Foundry software to help themselves deliver enhanced analytics as well as insights so they can be better prepared to identify and fight crime, terrorism, enhance health and transportation, as well as overall geopolitical tensions. Crisis 24 will also be able to improve their overall resilience, which will help influencers, special brands, as well as organizations become more stable. So overall, this is a very good strategic partnership, and I think this is going to reflect positively on their stock price, but that doesn't negate the fact that many professionals believe the PLTR share price is set to fall throughout 2023, down or potentially even below $5, but that's remained to be seen. We're just going to have to see what actually becomes of this company over the next year. But I would say that this company's partnership and their strategic agreement with Crisis 24 is a very good move towards the positive of this company potentially reaching profitability, which as of right now they are not profitable on a GAAP basis. The next company we're going to talk about is Tesla and their TSLA shares. And Tesla is mainly known as an electric vehicle company, but they also specialize in energy generation as well as energy storage. The TSLA share price is currently trading at $168 per share, while professionals believe this company could be worth as high as $436 over the next 12 months. Now, I think that is a rather high price prediction, but most professionals, including myself, believe the company is worth anywhere between $200 and $300 over the next year, particularly for 2023, but as of late, the TSLA share price has pulled back by close to 5%. The main reason for this is because multiple media outlets believe that investors as well as consumers are somewhat quote-unquote losing faith in this overall company. According to YouGov, Tesla is one of the most famous brands in the world right now, where around 97% of Americans that were surveyed have at least heard of Tesla. But of this statistic, around 28% of Americans have a neutral rating for Tesla, to where they don't like them but they don't hate them, and then less than 20% of Americans actually dislike Tesla, and the remainder of that would be investors as well as consumers who love Tesla. But despite these metrics, Barron's actually recently reported that Tesla's brand image is in the red according to them. However, I don't see that happening at all. Their share price is still very strong. The majority of investors that I talk to are still very bullish on Tesla, and overall, Elon Musk still has a lot of likability around him compared to other CEOs. I also want to add that right now, Tesla is actually trading at only 33 times their forward earnings. So their forward PE ratio is only 33. The reason this is absolutely amazing is because my main criticism for Tesla stock is their extraordinarily high PE ratio. And that used to be 160 times their forward earnings back in Q3 of 2020, where I was very critical of Tesla, and I myself did not buy Tesla stock at that particular time, because I was forecasting that this company would pull back in their share price, which is exactly what's happening right now. However, based upon the recent metrics from S&P Global Market Intelligence, we can see that it's only trading at 33 times their forward PE ratio, which makes Tesla stock a great buying opportunity compared to what they were trading at in the past, particularly in regards to Q3 of 2022. In summary, all that to say is that Tesla is becoming a better buying opportunity as their PE ratio falls, as they scale their overall earnings and revenue, on top of their overall share price falling, which gives long-term investors a better buying opportunity, because the cheaper we can buy Tesla, the better it's going to be over the long term. Tesla hasn't been this cheap in years, so I would encourage you to go and do your own research on this company if you would like to buy more, sell, or even make a position in this company if you are not already invested into Tesla. So I would say don't pay attention to what the media is telling you right now, where investors are losing faith in this company, because that's simply just not true. The next company we're going to talk about is Nio Stock, and this article goes into detail whether or not we should buy, sell, or hold Nio throughout 2023. Nio, ticker symbol NIO, is another electric vehicle company similar to Tesla, except this company is headquartered over in China. The current NIO share price is trading at $12.31 per share, while experts believe the company should be worth anywhere between $11.47 on the low end and $50 at the high end. Now, for me, I think this company could fall below or at least around $10 per share, and that's when I'm going to buy more of this company, because I do think this company has good long-term potential ahead of it. However, there is a huge risk for this company, and that is because they are a Chinese electric vehicle company. When you buy stocks outside of the United States, you're most likely investing into a shell company, which means you're buying ADR shares. You're not buying an actual share of this company. On top of that, as geopolitical tensions increase between the United States and China, these companies are going to lose their overall value. And if anything were to happen, and if China does something that the United States doesn't like, it's going to cause Chinese stocks to absolutely plummet. But in the meantime, you will have to weigh the risk to reward ratio for these various companies. For instance, throughout the year of 2022, many electric vehicle companies and stocks have lost their overall values. And this is because investors are very fearful of an overall deep recession, rising interest rates, as well as out-of-control inflation. That's why in the short to mid-term, investors are liquidating their risky growth companies. And Nio Stock was no exception. The stock price has plunged over 60% so far just in the year of 2022. But because the share price has dropped so low, isn't this a good buying opportunity? Well, let's determine that. Nio started to produce electric vehicles back in June of 2018, according to this article, and they've delivered around 274,000 electric vehicles so far. Particularly, just in the month of November, the company delivered over 14,000 electric vehicles, which means they are growing their overall deliveries by 30% on a year-over-year basis for that particular month. This is very good news. This means that they are going to increase their overall revenues and financial metrics, and if we pair that with the stock price being relatively cheap, this could be an amazing company to buy. That's why this author concludes that the stock's fall in their share price is unjustified, and that this is still a good company to buy. The reason why the company fell in the first place was due to macroeconomic headwinds, and now that Nio is actually managing these headwinds very well, the company is making a lot of progress. Another thing I'd like to point out is that they're not only a Chinese electric vehicle company that is specific to the Chinese market, they're also expanding further into the European market. For instance, it entered into the Norwegian market in September of 2021, and they have future plans to innovate and infiltrate the German market, the market over in the Netherlands, Denmark, as well as the Swedes. So clearly this company is just going to keep growing. But again, keep in the back of your mind that geopolitical tension is going to add a substantial amount of risk for this already very risky investment. On top of that, what I find interesting is that they are diversifying themselves into new businesses. But what do we mean by this? You've heard of the talk that Tesla wanted to get involved in smartphones, but now we actually have some news floating around that Nio is entering into the smartphone business, and that's going to be very interesting. I wonder if this is going to be a successful business, if these are rumors, or if these are actually going to come through to fruition. We're just going to have to see and wait to find out. On top of that, Nio's looking to increase their overall marketing and promotional activities as well as commercials, which will increase their overall marketing costs. Also, comparatively, when we look at the PS ratios of Nio, XPeng, Li Auto, BYD, and Tesla, we can see that Tesla is actually the most expensive according to a PE ratio basis, and BYD is actually the cheapest. BYD, ticker symbol BYDDY, is another phenomenal company also located over in China. But if you want to see a company kind of in the middle, Nio is a fantastic company to buy because it's right here in the middle in the purple, only trading at a PS ratio of 3.324, which is very impressive. From this list, I would say Tesla, BYD, and Nio are the best in different segments. But again, we're just going to have to wait to see how this overall electric vehicle market pans out. Nio expects overall to break even on their core EV business by the end of 2023. So as we enter into potential profitability, or at least closer to profitability in 2023, this company is absolutely set to explode, which is a huge catalyst for 2023. If you already own Nio, maybe holding this company throughout 2023 would probably be the best opportunity for you. It's probably not wise to sell this company as of right now unless something dramatic happens between the United States and Tesla, which is why the author of this article concludes that this company is a solid long-term buying opportunity. But in my opinion, I would say this is a holding opportunity. So I would disagree with the author of this particular article. And then finally, to round out the video, we're going to talk about Mullen stock, ticker symbol MULN, company name Mullen Automotive Inc. And they're currently trading at 19 cents per share, and I am anticipating a reverse stock split for this particular company. So Mullen is another electric vehicle company that is based in the United States, and they recently announced that they hired Ronald Dixon as their GM, which is their general manager, and he's going to be their general manager of government sales with a specific focus on US government vehicles. So why is this good? Well, first I would say this is very good publicity that Mullen is getting from this. I myself am very critical of Mullen. I am not going to invest in Mullen until this company actually proves themselves, because as of right now, I think that they have a lot of good ideas, pretty good technology, but they really haven't proven themselves as a business yet, so I'm waiting for that. So in the meantime, I find this company extraordinarily risky, and that there is so much risk in this company that I am not adding it to my portfolio, but I would love to hear what you think down below. The reason why this is an extraordinary opportunity for Mullen is that Ronald Dixon has around 42 years of automotive experience, including 2 decades of experience, particularly leading General Motors' federal government fleet sales team, and that is a huge flex. He was also responsible for selling over 500,000 units to the US federal government over the course of his career. The CCO of Mullen Automotive even commented on bringing Mr. Dixon on board by saying, and I quote, "Bringing on a seasoned government sales expert like Ron aligns perfectly with Mullen's 100% EV product portfolio and the federal government's desire to significantly increase their fleets with electric vehicles." If you aren't aware, the Biden administration issued a while ago an executive order in 2021 which focused on revitalizing the EV program, or the electric vehicle program, for US government vehicles. And essentially this executive order is requiring the replacement of old ICE vehicles and internal combustion engine vehicles to be substituted with fully electric vehicles. That means around 650,000 vehicles will need to be replaced, and Mullen wants to get a shot at that. However, I don't think that Mullen will be able to actually manufacture or even be contracted for this particular order, because Mullen just doesn't have the manufacturing capacity to focus on government electric vehicles as of right now. But I would love to hear your thoughts down below. Don't forget to smash that like button right now, comment your thoughts down below, subscribe if you are new, and I'll see you in the next YT video.